What if your bank account kept growing while you slept? Not because you picked up a second job, not because you started another exhausting side hustle, but because every single month, cash quietly showed up in your account simply because you own the right assets. That's the reality for people who live off dividends. And in this video, I'm going to show you the 3 fastest strategies people use to build serious monthly passive income through dividends, including how investors structure portfolios capable of generating $10,000 every single month. That's $120,000 a year in cash flow. Now, obviously, that kind of income requires real capital. But most people massively overestimate how much money they actually need because they only know traditional investing. Today, we're breaking all of it down. How dividends work, how much money you realistically need, the fastest strategy, the safest strategy, and the smartest way to combine them. When you buy a stock, you're not just buying a number on a screen. You're buying ownership in a real business. If that company makes profits, management has 2 choices. They can reinvest the profits back into growing the business or distribute part of those profits to shareholders. That payment is called a dividend. So instead of only hoping the stock price goes up, you're actually getting paid to own the stock. That's why dividend investing feels different. You're building an income-producing machine. Some companies pay dividends every quarter. Others pay monthly. And over time, those payments can eventually become large enough to cover your living expenses entirely. Now, here's the key number you need to understand: dividend yield. It tells you how much income an investment produces relative to its price. If a stock costs $100 and pays $6 per year in dividends, the dividend yield is 6%. Simple. And here's where things get powerful. If you know your target income and your expected yield, you can calculate exactly how much you need invested. The formula: your annual income goal divided by dividend yield equals required capital. At 3% yield, you'd need $4 million. At 6%, $2 million. At 10%, $1.2 million. At 20%, roughly $600,000. Higher yield means less money needed up front. But the higher the yield, the higher the risk. And this is where most investors make dangerous mistakes. They chase massive yields without understanding whether that income is actually sustainable. So we're talking about realistic income that can actually last. The first strategy for building high monthly cash flow is covered call ETFs. These funds own stocks and sell call options to generate extra income, which gets paid to investors every month. Think of it like this. Investors pay you for the chance to buy your stocks later, and that payment becomes your cash flow. That's why many covered call ETFs generate yields around 10–14% annually. At a 12% yield, you'd need about $1 million invested to make $120,000 per year. A traditional dividend portfolio at 3% would require over $4 million for the same income. This is why covered call ETFs have exploded in popularity among people pursuing financial freedom. The biggest advantage is consistent monthly income, even when markets move sideways. The downside is that these funds usually grow slower during massive bull markets because they sacrifice some upside for immediate cash flow. If your goal is maximum long-term growth, index funds may outperform. But if your goal is reliable monthly income now, many investors are comfortable with that trade-off. And if you're still building wealth, reinvesting is the real secret. Your dividends buy more shares, those shares create more income, and over time the snowball grows faster and faster. The second strategy is high-yield REITs, or real estate investment trusts, are companies that own income-producing properties like apartments, warehouses, hospitals, hotels, and data centers. By law, they must distribute most of their profits to shareholders, which is why many REITs offer much higher yields than traditional stocks. In simple terms, tenants pay rent, and part of that rent gets paid to you. This gives you real estate cash flow without dealing with tenants, maintenance, or property management. Some high-yield REITs can generate yields between 12% and 20% annually. At a 15% yield, earning $120,000 per year would require around $800,000 invested, even less than the covered call ETF strategy. But higher yields also mean higher risk. Some REITs carry heavy debt, making them vulnerable when interest rates rise, and sometimes extremely high dividends get cut unexpectedly. That's why diversification is critical. Experienced investors spread money across different sectors like apartments, healthcare, industrial buildings, storage units, and data centers. Different sectors perform differently depending on the economy. The third strategy is dividend growth investing. This strategy focuses on strong companies that consistently increase their dividends year after year. Many of these businesses, known as dividend aristocrats, have raised payouts for 25 years or more, even through recessions and market crashes. Unlike high-yield REITs or covered call ETFs, dividend growth stocks usually offer lower yields, around 4 to 7%. That means generating $120,000 per year may require between $1.7 million and $3 million invested. So why do investors love this strategy? Because it's built on reliability and long-term growth. These are financially strong companies with solid cash flow, powerful brands, and sustainable dividends that continue growing over time. Here's the real advantage. Your income can rise automatically every year. Imagine earning a 5% yield today, then those companies increase dividends by 6% annually. Without investing another dollar, your income keeps growing year after year. That's the hidden power of dividend growth investing. Your cash flow grows alongside the businesses themselves, helping protect you against inflation. You may sacrifice speed compared to higher yield strategies, but in return you gain stability, consistency, and long-term wealth growth. And for many investors, that trade-off is worth it. Most people think you have to choose one strategy. You don't. Smart investors often combine all three. Because the goal isn't to work for money forever. The goal is to build assets that work for you. If this video helped you understand how dividend income really works, subscribe for more content about building real wealth, real cash flow, and real financial freedom.